Do you want to maximize the returns on your properties? Do you want to know which one actually makes more money, Airbnb or long-term rentals? The answer is simple. Look at the numbers. But calculate not just revenue, factor in costs and effort too. Why does that matter? This slide explains everything. If you only look at the surface numbers, the answer seems obvious. Airbnb, $3,500 per month. Long-term rental, $2,000 per month. The revenue gap is $1,500 per month, $18,000 per year. A 75% difference in revenue. Overwhelming, isn't it? But there's a critical assumption behind these numbers. That $3,500 is a projection based on 70% occupancy, a top-performing property. In reality, the market average occupancy rate hovers around 50 to 60% in many markets. And you can't make the right call until you compare net operating income, NOI, after subtracting cleaning fees, management fees, maintenance costs, and vacancy losses from that revenue. Multiple studies confirm this. Short-term rentals can generate higher income, but they carry significantly more volatility, operating costs, and regulatory exposure. Ultimately, which strategy wins comes down to location and your starting assumptions. And this is calculable. Quantify your property's location, your management capacity, and your risk tolerance. Then choose your strategy based on those numbers. This is what changes your real estate investment decisions. Today, I'll show you the math behind it. That $3,500 per month figure, it looks attractive, doesn't it? But do you know the assumptions behind that number? 70% occupancy. That's the entire foundation. It assumes 21 out of 30 days are booked every month. Keep in mind, though, that in practice, blocked dates and minimum stay settings can shift how occupancy is actually calculated. Now, let's face the market reality head-on. According to AirDNA data, the annual average occupancy rate across most markets sits around 50 to 60%. Sustaining 70% is only realistic for top-tier properties or prime locations in high-demand cities. Assess your property honestly and determine whether it qualifies. Next, Airbnb's fee structure. You need to understand this precisely. Most hosts are on the split fee model, where the host pays around 3%. Guests pay an additional roughly 14% on their end. However, hotels and some professional hosts who opt for the host-only model see 14 to 16% deducted directly from their revenue. Check which model applies to your listing. You need to know this. Now, understand cleaning costs with the same precision. Cleaning fees can sometimes be charged separately to guests. In that case, the actual out-of-pocket cost to the owner differs. To calculate your true take-home, you need to clarify this and recalculate accordingly. Looking at the numbers honestly is the first step in architecting your wealth. Does that $2,000 from long-term rentals feel small? Before you decide, understand the quality of that number. $2,000 per month, $24,000 per year. What's the defining characteristic of this income stream? It's not subject to platform algorithm changes. It doesn't depend on tourist seasons. With a one-year lease, you can predict your monthly income. Of course, I won't claim long-term rentals have zero uncertainty. Vacancy risk occurs when tenants turn over. Late rent payments and unexpected repair costs are real risks. But compared to Airbnb, the fluctuation is far smaller and far more predictable. Management effort, about 1 hour per month. Collecting rent and responding to tenant inquiries. Compare that to Airbnb's roughly 10 hours per week, about 520 hours per year. That difference is time you can invest in other assets or your primary business. Delegating to a property management company is also a realistic option. According to NARPM, PM fees range from a few percent to over 10% of monthly rent. There's also typically a one-time leasing fee when finding new tenants. Factor these in and compare take-home income against Airbnb. That's how you make an accurate decision. The fundamental value of long-term rentals is predictability. You know next month's income today. You can calculate next year's income today. Do you understand how powerful that certainty is when it comes to building wealth? To succeed with Airbnb, you need to invest up front. Understand the scale of that investment precisely. Here's the breakdown of startup costs. This is a projection for a single unit with 1 to 2 bedrooms. Furniture and decor, $5,000 to $10,000. Photo-ready interiors are non-negotiable. Professional photographer, $300 to $500. Your search ranking on Airbnb is determined by photo quality. Initial amenities, $500 to $1,000. Shampoo, coffee, towels, consumables. Smart locks, Wi-Fi routers, and other equipment, $500 to $1,000. Total, $10,000 to $20,000 is your starting line. Keep in mind this varies significantly based on property size and existing furnishings. Now let's look at management effort, realistically. If you're managing manually, roughly 10 hours per week is a realistic estimate. Guest communication, cleaning coordination, message responses, maintenance scheduling. Automation tools and a PMS property management system can cut that time down. But even with tools, a minimum of a few hours per week is unavoidable. Here's where you calculate your time cost. Your hourly rate multiplied by your weekly operating hours, that's your opportunity cost. Subtract that amount from the monthly revenue gap before you make any comparison. You also have the option to fully outsource Airbnb operations. Full-service short-term rental management typically runs 20 to 30% or more of gross revenue. Factor in the cost difference versus long-term rental PM fees, always. Numbers don't lie. Ignoring hidden costs is how investment decisions fail. What's the most overlooked risk in Airbnb investing? It's not occupancy rate. It's not costs. It's regulatory risk. In September 2023, New York City significantly tightened its short-term rental registration system. The core of that registration system wasn't just registration. It required hosts to be present on the premises as a primary condition, with strict requirements imposed on rentals under 30 days. The result? Within a few months, more than 70% of listings that couldn't meet those conditions disappeared. Hotel prices surged, and investors took an irreversible blow. And this isn't just a New York story. Barcelona, Amsterdam, Paris. Reports from the OECD and Lincoln Institute of Land Policy show that tightening short-term rental regulations in major global cities is a sustained trend. To accurately assess regulatory risk, check these 4 factors. First, registration requirements. The difficulty and cost of obtaining permits. Second, primary residency requirements. Is host co-occupancy mandatory? Third, annual night caps. Is operating beyond the cap prohibited? Fourth, fines and enforcement strength. Does the regulation have real enforcement power? Depending on these 4 factors, the same regulatory tightening can mean anything from a sharp decline to total market elimination. Before you invest, research all 4 of these, without exception. There's one more reality you need to know. The post-pandemic surge in travel demand triggered a wave of new Airbnb entrants. And what happened as a result? In some markets, oversupply has been reported to lower per-property revenue. AirDNA calls this the Airbnb bust, and it's not just seasonal fluctuation. It's a structural increase in competition that extends the payback period on your initial investment. In response to this reality, a new trend has emerged: medium-term rentals of 30 days or more. 3 reasons explain why medium-term rentals are gaining traction. In many markets, they fall outside the scope of short-term rental regulations. There's stable demand from business travelers and remote workers. Lower cleaning frequency improves cost efficiency. Think of this as an evolution of the hybrid strategy. Short-term in peak season, medium-term in the off-season. A strategy that avoids regulatory risk while raising the revenue floor. The market is changing. In some markets, the days of enter and profit with Airbnb are coming to an end. You need to check the current occupancy data for the market where your property is located. Airbnb or long-term rental. Are you convinced those are your only 2 options? There's a flexible alternative: the hybrid strategy. Let's look at a specific example. An owner with a property in a tourist destination switches strategies based on the season. For 6 months in summer, they run it on Airbnb. 85% occupancy, $4,000 per month. For 6 months in winter, they switched to a long-term rental. Stable income of $1,800 per month. Annual revenue, $34,800. But don't take this projection at face value. Switching between models carries real costs. Vacancy periods and leasing expenses when transitioning from long-term to short-term. Constraints from minimum contract lengths in long-term leases. And the legal treatment of medium-term rentals in your property's market. As the Lincoln Institute of Land Policy points out, switching rental models comes with transaction costs and legal constraints. Factor all of these in and run your projection on a net operating income basis. That's the only way to make an accurate call. The conditions where hybrid works best are clear. Resort areas, tourist destinations, cities with frequent large-scale events. Locations with high seasonal demand swings where short-term occupancy drops sharply in the off-season. First, verify whether your property meets these conditions. Now, let's consolidate the key takeaways from today. Here's today's summary. First, compare on NOI, not revenue. Airbnb at $3,500 per month versus long-term rental at $2,000. Those are revenue figures. Only when you subtract fees, cleaning costs, management fees, maintenance costs, and vacancy losses to get net operating income, NOI, will you see which one actually makes more money. Second, calculate hidden costs precisely. The market average occupancy rate for Airbnb is 50 to 60%. 70% is a top performer benchmark. Multiply your hourly rate by your weekly operating hours to get your opportunity cost and subtract that from the revenue gap. And regulatory risk. Research all 4 factors before you invest: registration requirements, primary residency requirements, annual night caps, and enforcement strength. Third, the optimal strategy is determined by your property, your location, and your lifestyle. If you're chasing high returns, go with Airbnb, but it comes with effort and risk. If you want stability, go with long-term rentals. If your location has strong seasonality, hybrid or medium-term rentals are worth serious consideration. What strategy is your property running on right now? And is that choice truly optimized on an NOI basis? Share your strategy in the comments. Your property's location, your current approach, and what this video revealed to you. That becomes the collective wisdom of this entire community. Thanks for investing your time with me today. We did a data-driven, head-to-head comparison of Airbnb versus long-term rental income, numbers and facts only. This channel delivers actionable strategies for real estate investing, asset allocation, and financial freedom, backed by data and calculations every time. If you want to architect your wealth with numbers, not emotions, hit subscribe and turn on notifications. See you in the next one.